Hey, Kathy, as you said, one of the things about ARK, it's certainly in its DNA, is that you go places and take positions that other people maybe don't do. And one of the things, though, that increasingly I feel like the financial establishment, again, is interested very much so is in crypto. And I want to talk about your spot Bitcoin ETF, if I may, the ARK 21 shares
Sure.
Bitcoin ETF. What can you tell us about institutional interest in it? Is there, or is it mostly the funds that are going into it are mostly from the retail side?
Well, we know there's institutional interest because we're talking to a lot of institutions, including state treasurers and public pension funds. And why is this? Because they're trying to figure out if this truly is a new asset class. And if it is, they must have a point of view. As a fiduciary, if there's a new asset class, which is uncorrelated or shows very low correlation in terms of returns relative to other asset classes, then what an asset allocator does is it will take a position to increase returns per unit of risk. That's what happens with low correlation of returns. So definitely, now, are they moving whole hog? Not yet. Mm-hmm. And nor are the big wirehouses like the Morgan Stanleys and UBS's, Wells Fargo, Merrill Lynch, B of A. They are all waiting to see who are the winners in terms of the ETFs, because they do not want to commit to an ETF that will close down. And
makes sense.
Right. So, and they're going to give it, from what we're hearing, 3 to 6 to 9 months. So everything, the net inflows that we've seen, and are away from those two spaces, really. It's part of it is our client base switching from GBTC into, and other client bases, into the ETFs, which are much lower fee.
All right, but I do want to also then go to the next level, and that is an Ether ETF being approved maybe in May. Are you optimistic that it's going to happen by that May deadline, or what obstacles might be still out there that it won't make that deadline?
Yeah, so the biggest obstacle is staking, and I don't think the regulators will allow staking in this first round, if they allow the first round at all. Now, we and one other firm will see our final deadline in May. If they reject our filings, then we'll have to refile. But my guess is they will move more now to a first come, first serve when this next round goes through. So if it's May, it'll be without staking. If it's later, there's a better chance for staking. If it's in, I would say, 2025, because I think legislators and legislation is starting to get involved here and taking it away from simply the regulators.
Whoa, did you catch that? Cathy Wood just revealed some bombshell insights about institutional interest in crypto ETFs. If you're an investor keeping tabs on the latest trends, this is huge news you can't afford to miss. Welcome back to InvestMinder, your go-to source for staying ahead of the curve in the ever-evolving world of investing. If you're new here, make sure to subscribe and hit that bell icon to never miss an update on the hottest investment opportunities and strategies. Now, before we dive deeper, let's get this clear. We are not a professional financial advisory firm, and our content is for educational and entertainment purposes only. We strongly recommend consulting with licensed professionals for personalized investment advice. With that said, let's unpack the juicy details Cathy Wood shared. From institutional giants like Morgan Stanley and UBS, to state treasuries and public pension funds, the financial establishment is eyeing crypto ETFs as a potential new asset class. And with the promise of low correlation and potential for boosting risk-adjusted returns, it's no wonder they're keeping a close watch. But the real question is, will the regulators give the green light for an Ether ETF by the anticipated May deadline? Or will staking requirements throw a wrench in the works? Cathy Wood seems cautiously optimistic, but only time will tell. Before we dive into the nitty-gritty details, let's take a step back and understand why this news is such a big deal. For years, cryptocurrencies like Bitcoin and Ether have been viewed as speculative assets, dominated by retail investors, and often met with skepticism from traditional financial institutions. However, As the crypto market has matured and gained mainstream recognition, we're witnessing a seismic shift in perception. Institutional investors, once wary of the volatility and regulatory uncertainties surrounding digital assets, are now actively exploring ways to gain exposure to this emerging asset class. And it's not just the allure of potential high returns that's piquing their interest. As Cathy Wood astutely pointed out, cryptocurrencies like Bitcoin offer something truly unique: low correlation with traditional asset classes like stocks and bonds. In the world of portfolio construction, this characteristic is like striking gold. By adding an asset with low correlation to their portfolios, institutional investors can potentially enhance their overall risk-adjusted returns. Think of it as a diversification superpower, allowing them to spread their risk across different asset classes that don't move in lockstep with each other. Why the sudden rush of interest in crypto ETFs specifically? Well, for institutions managing large pools of capital, ETFs offer a convenient and regulated way to gain exposure to an asset class without having to hold the underlying assets directly. It's a one-stop shop that simplifies the investment process while providing the necessary oversight and transparency that institutional investors demand. And let's not forget the potential benefits for retail investors like ourselves. With institutional money pouring into crypto ETFs, we could see increased liquidity and potentially lower volatility in the long run. It's a win-win situation, opening up new avenues for both individual and institutional investors to participate in this exciting space. Now, of course, there are still hurdles to overcome. Regulatory approval is a significant roadblock, and as Cathy Wood mentioned, the staking requirements for Ether ETFs could be a potential deal-breaker, at least in the short term. But with legislators and regulators increasingly being pulled into the crypto conversation, we may see a more favorable landscape emerge in the coming years. So, what does this all mean for you, the savvy investor? Well, it's a clear signal that the crypto revolution is far from over, and the institutional embrace of this asset class could be a game changer. Whether you're already invested in cryptocurrencies or still on the sidelines, keeping a close eye on the developments in the ETF space could prove to be a wise move. While the prospect of institutional money flowing into crypto ETFs is undoubtedly exciting, it's important to approach this development with a level head and a critical eye. After all, the world of investing is riddled with complexities, and even the most promising opportunities come with their fair share of risks and challenges. One of the key concerns that immediately comes to mind is the potential impact of institutional investors on market dynamics. Historically, when large players enter a relatively small and volatile market, it can lead to increased volatility and liquidity issues, at least in the short term. Imagine a scenario where multiple institutional investors pile into a particular crypto ETF, creating a supply-demand imbalance. This could potentially drive up prices in an unsustainable manner, setting the stage for a potential correction down the line. Conversely, if these deep-pocketed investors decide to exit en masse, it could trigger a sharp sell-off, leaving retail investors holding the bag. Another factor to consider is the regulatory landscape surrounding crypto ETFs. While Cathy Wood expressed cautious optimism about an Ether ETF receiving approval by May, the truth is that the regulatory environment remains a constantly shifting terrain. Regulators have a delicate balance to strike. They need to foster innovation while ensuring adequate investor protection and market integrity. This balance is often challenging to achieve, especially in a rapidly evolving space like cryptocurrencies. It's worth noting that regulators have historically been cautious when it comes to approving crypto-related products, citing concerns over market manipulation, custody risks, and the potential for illegal activities like money laundering. While progress has been made in addressing these issues, regulatory hurdles remain a significant obstacle. Furthermore, even if regulators do greenlight crypto ETFs, it's crucial to understand that these products may come with their own set of rules and restrictions. For instance, as Cathy Wood mentioned, staking requirements for Ether ETFs could be a sticking point, at least initially. This could potentially limit the appeal and functionality of these products for certain investors. Another consideration is the fees associated with crypto ETFs. While Cathy Wood highlighted the lower fees of ETFs compared to other investment vehicles like the Grayscale Bitcoin Trust, GBTC, it's essential to understand that fees can vary significantly among different ETF providers. These fees can eat into returns over time, especially for long-term investors. Lastly, it's worth remembering that crypto ETFs, like any investment product, are not immune to the inherent volatility and risks associated with the underlying assets. cryptocurrencies are known for their wild price swings, and even institutional involvement may not be enough to tame this volatility entirely. So what's the takeaway here? While the potential influx of institutional money into crypto ETFs is undoubtedly exciting, it's crucial to approach this development with a healthy dose of caution and due diligence. Thoroughly understand the risks, do your research, and consult with qualified financial advisors before making any investment decisions. As we delve deeper into the potential impacts of institutional money flowing into crypto ETFs, it's important to consider the broader implications this could have on the crypto ecosystem as a whole. On one hand, increased institutional participation could bring much-needed legitimacy and credibility to the crypto space. For years, cryptocurrencies have been viewed with skepticism by traditional financial institutions, often dismissed as a speculative fad or a playground for unsavory activities. However, as respected names like Morgan Stanley, UBS, and state pension funds throw their weight behind crypto ETFs, it could signal a paradigm shift in perception. These institutions have teams of analysts and experts who have likely conducted extensive due diligence before considering exposure to this asset class. Their stamp of approval, albeit cautious, could be the catalyst that encourages other institutional players to follow suit, leading to a virtuous cycle of increased adoption, liquidity, and stability in the crypto markets. Moreover, the influx of institutional capital could potentially drive innovation and development within the crypto ecosystem. With deep pockets and vested interests, these investors may demand improved infrastructure, better custodial solutions, and robust regulatory frameworks. This could accelerate the maturation of the crypto space, fostering the growth of ancillary services and technologies that cater to the unique needs of institutional investors. From secure cold storage solutions to advanced trading platforms, the ripple effects could be far-reaching. However, it's important to recognize that not all institutional involvement is inherently positive. There are valid concerns about the potential for market manipulation and unfair advantages that deep-pocketed investors may wield. If a handful of large players gain outsized influence over a particular crypto ETF or the broader market, it could undermine the core principles of decentralization and equal opportunity that cryptocurrencies were founded upon. Additionally, some purists within the crypto community may view the influx of institutional money as a form of co-option, arguing that it goes against the anti-establishment ethos that initially fueled the crypto revolution. There are also concerns about the potential for increased regulatory scrutiny and government intervention. As institutional investors become more deeply entrenched in the crypto space, regulators may feel compelled to impose stricter rules and oversight, which could stifle innovation and undermine the very essence of cryptocurrencies. Furthermore, it's crucial to acknowledge the potential systemic risks that could arise from a tighter integration of traditional finance and the crypto world. If institutional investors suffer significant losses due to market volatility or unforeseen events, it could have ripple effects throughout the broader financial system, given the interconnected nature of modern markets. As we navigate this uncharted territory, it's imperative to strike a delicate balance between fostering innovation, protecting investor interests, and preserving the core principles that gave rise to cryptocurrencies in the first place. While the prospect of institutional money pouring into crypto ETFs is undoubtedly a momentous development, it's important to remember that this is just one piece of a much larger puzzle. The crypto landscape is vast, ever-evolving, and extends far beyond the realm of exchange-traded funds. One area that deserves equal attention is the burgeoning world of decentralized finance, DeFi. From decentralized lending and borrowing platforms to automated market makers and yield farming protocols, DeFi represents a paradigm shift in how we conceptualize and interact with financial services. And while institutional investors may be primarily focused on crypto ETFs for now, the potential disruption that DeFi could bring to traditional finance cannot be ignored. Moreover, the ongoing development of Layer 2 scaling solutions and the emergence of new blockchain networks like Solana and Avalanche are opening up new frontiers for innovation. These advancements could pave the way for faster, more efficient, and more scalable decentralized applications, potentially unlocking new use cases and business models that we can scarcely imagine today. It's also worth noting that the crypto space extends far beyond the realm of finance. Non-fungible tokens, NFTs, have captured the imagination of artists, creators, and collectors alike, enabling new forms of digital ownership and monetization. Meanwhile, decentralized autonomous organizations, DAOs, are exploring novel governance models and redefining the way we think about organizational structures and decision-making processes. As we look toward the future, it's clear that the crypto revolution is not a monolithic phenomenon, but rather a multifaceted movement that touches upon virtually every aspect of our digital lives. From finance and art to governance and social interactions, the potential applications of blockchain technology and decentralized systems are vast and far-reaching. While institutional investors may be primarily focused on the potential returns and diversification benefits offered by crypto ETFs, it's important for us, as individual investors and enthusiasts, to maintain a broader perspective. By staying informed and engaged with the various developments across the crypto ecosystem, we can not only identify potential investment opportunities, but also play a role in shaping the future of this transformative technology. Whether it's participating in DeFi protocols, exploring the world of NFTs, or contributing to the governance of DAOs, there are numerous avenues for us to actively engage with and shape the crypto revolution. By doing so, we can ensure that this movement remains true to its core principles of decentralization, transparency, and equal opportunity, even as institutional money and traditional finance players enter the fray. As we bring this exploration of institutional money flowing into crypto ETFs to a close, it's clear that we are standing at the precipice of a pivotal moment in the evolution of the crypto ecosystem. The potential influx of institutional capital represents both immense opportunities and complex challenges that must be navigated with care and foresight. While the allure of potential returns and diversification benefits is undeniable, we must remain vigilant and critical in our approach. Thorough due diligence, a deep understanding of the risks, and a commitment to staying informed about the ever-changing regulatory landscape are paramount. At the same time, it's crucial to remember that the crypto revolution is a multifaceted movement that extends far beyond the realm of ETFs. The worlds of decentralized finance, non-fungible tokens, and decentralized autonomous organizations are brimming with innovation and potential, offering us the chance to shape the future of this transformative technology. So as we move forward, let us embrace the spirit of curiosity, adaptability, and open-mindedness that has fueled the crypto revolution from the very beginning. Whether you're a seasoned investor or a newcomer to this exciting space, there has never been a better time to engage, learn, and potentially contribute to this dynamic ecosystem. Remember, at InvestMinder, our mission is to empower you with knowledge and insights that can help you navigate the ever-changing landscape of investing. Stay tuned for more thought-provoking content, and don't forget to subscribe and hit that bell icon to never miss an update. Until next time, keep exploring, keep learning, and keep shaping the future of finance and technology. The crypto revolution is just getting started, and the possibilities are endless.
Hope you found today's analysis helpful as you look for profitable new stock opportunities. This was InvestMinder. Remember, knowledge equals profit in the stock market. Thanks so much for watching, and please hit that thumbs up button if you got value from this video. Make sure you click to subscribe as well to get our next videos when we reveal the best new insider stock purchases. Invest wisely, trade carefully, and we'll see you next time. Disclaimer: InvestMinder is an independent stock market commentary channel for entertainment and basic informational purposes only. We are not licensed financial professionals and do not provide personalized investing or financial advice. P.S. If you stayed watching until here, you are awesome. Thank you for enabling me to keep making these videos with all the likes and subscribes. Have a great day, and we love you all.